You guys want to know what a $5 million warehouse looks like? Just have a look behind me. I'm here to check out whether this property is actually worth $5 million. I've been told it sits on a 5,500 square meter piece of land, which checks out, and it's a 3,000 square meter high clearance warehouse, which also checks out as well. I think it is worth about $5 million. It's got an ASX listed tenant that's leasing the property at the moment, and they're paying $330,000 in net rent. That works out to be about 6.6, almost 7% net yield, which is pretty amazing. In my opinion, I think they're paying slightly under market rent right now. I think they're paying, and based on the square meterage, they're paying probably around $110 per square meter. And I think the market rent here is probably around 140, 150. So there's probably some room to get some rental uplift. Would I recommend this to a client? I think so. So let me go back to the office, run some numbers, and see whether it would actually stack up. But on face value and based on what I can see so far, I think it's a pretty good investment. Hey, I'm not the selling agent here, I'm just the buyer's agent, but from what I can see, it looks pretty good. Okay, I've just opened up my computer. So let's have a closer look at this property and figure out whether it actually stacks up and whether it's actually investment worthy. So just to start off with, in case you're not too familiar with where Sumner is strategically located in between Ipswich as Brisbane CBD. As some of you guys already know, there's a lot happening around this part of town, a lot of infrastructure spending, a lot of price movements, a lot of domestic migration, as well as just huge population growth. So all along this area is considered the Western Corridor, and it's been experiencing phenomenal growth, both in terms of residential property and obviously commercial properties as well. Now, I haven't given you the address, but I'm going to give you the address now. So the property we're looking at is number 67 Woolston Road, which is located right here. Okay, it's just to give you guys some bit of bearing. So this is what we're looking at right now. So why do I like this property? Well, there's a number of reasons. Number one, it's a nice, sizable warehouse. It's strategically located in an area that is fast growing, one of the fastest growing areas. And this is what we would consider a secondary grade property, which is where all the growth is. So basically there's prime assets, there's subprime, so there's super prime assets, and secondary assets. And basically, in other words, it's A grade, B grade, C grade, etc. This is considered secondary, and it's been just a lot of growth in the Western Corridor of Brisbane for secondary industrial assets. But so just going through the IM very quickly, obviously you've seen my video about my walkthrough, but what I really like about this property is, first of all, it's got a really solid tenant. So the Australian Mud Company is a subsidiary of IMDEX. It is a ASX listed company, and they're basically a mining tech company. They've been in the building already for about 3.5 years, and they've got about 2 years left in their lease, and there's no option. There's no option, which is really great for us because that means we've got a lot of flexibility in what we want to do with the property. Now, some of you guys might say, "Oh, well, it's only 2 years. Doesn't that mean the tenant's going to move out? There's no security of rental and all that type of stuff." Well, let me explain why this is a good thing. And one of the main reasons is, as you can note here, they're currently paying about $332,000 in rent, and that is actually under market rent. And I'll show you the feasibility in a second. So, number of reasons why I really like this. Number one, strategically located. Number two, high growth area. Number three, good solid tenant, and number four, with a good significant potential rental uplift. So let's take a closer look at the feasibility. So the property was originally asking about $5 million, ended up selling for $4.75 million. And based on the figures here, it represents a 7% net yield. 7% net yield with an ASX listed tenant. So that's a pretty damn good yield if you ask me. Now, as you can see from the figures here, they're paying about $112 per square meter right now. That's the current rent at the moment. And I'm going to show you very quickly why this is under market rent. So we're looking at some of the leasing evidence. So some properties on the market and some properties off market. Now, the challenge with a place like Sumner is that there just hasn't been a lot of leasing transactions the last 12 to 18 months because the market's so tight. The vacancy is less than 1.1% in this market. So as you can appreciate, there hasn't been a lot of leasing activity. So evidence in terms of number of leasing evidence has been pretty low, but there's just enough to give us a really good idea of where the market rent is. So as you can see, with the exception of Gigi Street, all the rents are above 130 square meters, $130 per square meter. That's the rental market in Sumner. So I'll show you what we've adopted in a second, and then obviously we'll look at what are the sales activity. So again, there hasn't been a ton of sales activity, but there's just enough for us to formulate a good view of the market. What we're looking at the moment is obviously what property I've been selling in terms of rate per square meter of land, rate per square meter of build, and what are the yields. With the exception of this property, yields are hovering, around that 5 3/4 to about 6.5%. And this 7% yield is absolutely phenomenal. So let's have a look at what we adopted in terms of market price. So based on the evidence here, and by the way, you guys feel free to Google all these addresses. And what I did as part of the inspection, I actually went out and inspected all those properties in this spreadsheet. So I've got a pretty good feel of where the market is. So having a look at all the evidence and inspecting all these properties that are relevant and comparable to 67 Woolston Road, we've adopted market rent for a property like this of somewhere between $140 to $160 per square meter, which means that if this property was vacant today, it should fetch somewhere between $140 to $160 per square meter net. In terms of land value, we've adopted somewhere between $1,000 to $1,200 per square meter, and there's a building per square meter value, somewhere between $1,600 and $2,100 per square meter. So this is what we've adopted for this particular property. So obviously, at $4,750,000, it works out to be just under $900 per square meter on land, and just under $1,600 per square meter on build, which sits just below or just at the lower range of a market pricing or market valuing. So what that means is that there is room for improvement. There is definitely upside potential here. So let's have a look at what the upside actually represents. So as I mentioned, the tenant has a lease expiry in a couple of years' time with no option. Their current rent is $132,845, representing $112 per square meter. Now, the current market rent range, as I mentioned, we've adopted $140 to $160 per square meter, which equates to about $415,000 to about $475,000. Now, if we just look at the lower rent range and at the same cap rate, obviously, when we end up renewing the lease, if we had the opportunity to renew the lease on a 5 + 5 year lease, the cap rate's probably going to be a little bit sharper. It's probably going to be closer to about 6.75. But even if we adopt the same cap rate, there's over $1 million worth of capital growth there, just by simply adjusting the rent. Now, obviously, that's something that we can't do for a couple of years, but let's have a look at our feasibility and where the real upside is. So what the idea here and the strategy here is we buy the property and we keep it for 2 years and enjoy the strong cash flow, the strong 7% net yield cash flow, and then hit the tenant with a market review in a couple of years' time. So this is what the feasibility looks like. So this is the acquisition price, $475. This is the stamp duty, and obviously there's some closing costs, being the building inspections and legal costs and all that type of stuff. So you're in for $5,028,000 in terms of your acquisitions costs. Now, assuming whenever we do these feasibilities, we always account for worst case scenario. So in a perfect world, we're able to renew the lease with the existing tenant, but when we're buying the property, when we're doing the feasibility, we're on account for the worst case scenario being that the tenant moves out. So if the tenant does move out in 2 years' time, we obviously need to attract a new tenant and we need to release the property. Now, I've accounted for a 6 months vacancy in the event that the tenant moves out in 2 years' time. So if we have to attract a new tenant, obviously we have to pay leasing fees to the real estate agent, which is typically about 13% of the rent. There's probably about 10% worth of incentives that we're going to offer to a new tenant, which equates to about 270,000. There's going to be obviously 6 months of interest payments because we're accounting for a 6 months vacancy and 6 months worth of outgoings that we need to pay as well. But the good thing is we'll be collecting rent over the next 2 years. And this is going to be the rental surplus, the positive cash flow that we're going to get. So that obviously offsets a lot of its costs. So you're in for about $87,000 in releasing costs if the tenant moves out. So your total costs in, across a 2 year span to renew the lease is about $5,115,000. And the new valuation on this property is potentially $6.7 million, which represents a $1.673 million value uplift, which is about 32% profit margin based on cost, not based on purchase price, but based on cost. So in 2 years' time, you'll be able to experience a $1.67 million net profit based on cost on a property like this, which is pretty good. So okay, so right now the numbers do stack up pretty well, but how confident am I on these numbers? How confident am I on these numbers? Well, I don't know about you, but like I'm a bit of a geek in terms of like research and things like that. I love reading research reports, and I recently downloaded the CBRE industrial and logistics report on Brisbane. Now, I've worked for CBRE and I worked for JLL and a bunch of other global real estate firms. And I'm going to tell you, CBRE and Jones Lang LaSalle or JLL produce the best research. Okay, so if you want to look at anything, you want to geek out on research, go to JLL or CBRE's website and you can download some of these reports for free. Now, what I'm looking at is just the leasing market and how well it's performed. And if I look at some of these comments here, we can see that secondary, I don't know if I can highlight this, but secondary rents have increased by 20.8% over the year. Okay, secondary assets in the Western, in the Brisbane market has gone up 20.8% over the last 12 months. And that's because of a couple of factors, tight supply, high demand, and bigger tenants just being squeezed out of the prime assets, which means they have to lease secondary assets. And furthermore, in this paragraph, they expect that Brisbane rents continue to grow at above historical rates over 2023 to 2027 due to solid population growth, limited supply, and continued demand for space by large occupiers, et cetera, et cetera. So in my opinion, secondary property rents are going to go up by double digits over the next 2 to 3 years. Whether they're going to hit 20% or not, we're going to wait and see, but definitely by double digits. So obviously, feel free to download this report and go through the rest of it. It contains pretty good data. So if that was the case, and let's say the market rent at the moment, we're adopting $140 per square meter only, and let's say the rental market goes up by minimum 10% over the next 2 years, we're most likely going to hit $160 per square meter as a market rent minimum in a couple of years' time. So am I pretty confident about these numbers? I'm pretty confident, but hey, look, at the end of the day, I don't have a crystal ball. I cannot guarantee this outcome, but based on all the evidence, based on all the research, we believe that this asset does represent pretty good value, and that's why we recommended it to our client. In terms of a cash flow perspective, how much is it going to cost to fund this acquisition? Well, based on a $4,750,000 purchase price, we can definitely borrow up to 65%. So roughly about a $3 million loan, which means you need to put in about $1.9 million of your own money. So being 35% deposit, stamp duty, closing costs, etc. So if you put in $2 million, you go for a lease stock loan with Westpac or one of those major banks, and just sit on a property for in a couple of years' time, you can potentially experience $1.6 million in uplift. So which is pretty good. So in terms of the numbers, the properties, in our opinion, does stack up. So what about some of the other important information? Well, we've got a copy of the lease. So we've gone through the lease and there wasn't any red flags. It looks pretty solid. And, it's got all the rental income details, rental review details. So it's all in there. So the lease looks pretty solid. What about the building? So obviously we went through the building and got a building report, and the building looks pretty solid. The roof was replaced about 5 years ago. There's no red flags in terms of the building. So if the property is so good, if the property is leased to an ASX tenant, there's nothing wrong with the building. Why is it being sold for 7% and not better? Why isn't it selling for higher? Like, why isn't it selling for like 6.5% net yield, which is what some of the other comparable buildings are selling? Well, so we had to dig a little bit deeper in our due diligence and figure out why that's the case. The market's pretty effective. So there's two reasons why. So number one is because of the WALE, so the weighted average lease expiry. Because this property only has a 2-year lease expiry, a lot of the more established investors, like the funds, syndicates, they shy away from them because most of them don't want longer lease terms. They want minimum 3-year lease terms because it ties in with their funding a little bit better. So so that buyer pool sort of disappeared. Okay, so we've got less people investing in it, which means that the leftover buyers are more opportunistic, like our clients in Property Alliance are more opportunistic. And the second reason, which is a very important reason, is that we've discovered that this property actually sits in the Brisbane city's flood map. Okay, now you got to understand what this actually means. So a lot of people, when they hear, oh, well, properties are sitting in the flood zone, they automatically assume the worst and they shy away from it. Now, basically what it means is any property that's within close proximity to a creek, to a river, canal, whatever, automatically sits in the flood zone map. But what we as good investors need to do is actually dig a little bit deeper and figure out how does it actually affect the actual property. Now, one of the reasons why this property is getting 7% net yield is because majority of investors, like 90% of investors, or maybe 80% of investors, when they hear flood zone, they automatically discount the property. And that's where they miss out on the growth, where they miss out on the actual upside. So we downloaded this flood report, and we're able to have a look at it a little bit closer. Now, the chances of this property flooding and being affected by flood is less than 2%. As indicated in this report. And furthermore, we spoke to the agent who's selling the property, and he's indicated that the property was not affected during the 2022 flood. It was not affected during the 2022 flood. And this is when the ASX company was already in place in terms of being a tenant. Well, lastly, as an investor, we want to make sure that we are covered in the event of a flood. And here we go. So we've got a insurance quote, which covers the flood, which looks pretty good. So all in all, when we consider everything, when all things are considered, number one, good growth location. Number two, amazing upside. Number three, good initial yield. And number four, good solid tenant. We deem that this risk factor in terms of being in a flood zone is something that we can wear, particularly because there's insurance that covers it. So guys, hopefully this video helps you understand our process, help you understand how we find properties for our clients, and help you understand how we analyze properties. Now, this property, as I mentioned, was purchased for $4.75 million recently at 7% net yield with significant rental uplift in a couple of years' time. Now, if you're interested in finding properties just like this or similar to this, and you want help, you want expert help from a company like mine, then please feel free to reach out or feel free to jump on my website and check out some of our other case studies. All right, if you did enjoy this video, then please subscribe so that you can get more videos like this and look at more property opportunities just like this. All right, Will Tong here. Thank you so much, and I'll see you in the next video.